And there, on the other side of that, there is a theory known as the efficient market, which means that everything you think you know or that is new news to you has already been priced in.
Peter, it's so good to see you. Welcome back to everyone. We are going to dive into the headlines today, talking about markets and geopolitics. When will stocks recover? Rising tensions in Iran have pushed oil prices higher and created short-term volatility in the markets. Historically, however, geopolitical conflicts tend to have only a temporary impact on stocks. To see what that looks like, Peter, let's take a look at this chart from FinViz, which shows the S&P performance for the past month. We see a lot of red on the board. So why do we tend to see stocks fall first when tensions rise?
Well, yeah, a lot of red on the board, but there's some green scattered in there as well. And people will say, well, I thought the S&P was one thing. It's an index of over 500 different companies. Some behave in different ways at different times. And so there is a smattering of green there. And what we're seeing so far this year is a trend of sector rotation. Those magnificent seven, those high-flying tech heavy stocks that have done so well and carried so much of the appreciation over the last 5 or so years have cooled to start 2026. And some of the more stable value, long-term stocks, the dividend producers have really seen a moment to shine here to begin the year. The sector rotation is that those that were out of favor are now in favor. Those that were in favor may have had more of a reaction to this event, but I think also been in the midst of a bigger trend downward even before the Middle East and Iran. Stocks are reactive. The market is reactive. It's emotional. When things happen that it was not expecting, it gets priced in rather dramatically, usually fairly quickly. And there, on the other side of that, there is a theory known as the efficient market, which means that everything you think you know or that is new news to you has already been priced in. So when a real surprise happens, the market tends to not like it. But here's the good news to the negativity that we're hearing about is that some of the best days in the market happen right after some of the worst days. Some of the best months happen right after some of the worst months. And the market is resilient. And so we really don't want to be emotional ourselves. The market is emotional enough. So if we've got a long-term plan and long-term vision, generally the advice in a time like this is stick with it.
All right, so let's take a closer look at history. And I want to show you this chart because this shows the S&P 500 does usually recover relatively quickly from geopolitical events. So this lays out several events here. You can see them labeled and mostly short, shallow pullbacks. Talk us through what we're looking at.
Yeah, and some of the ones that you're not seeing a label for there on the board: the Korean War, the Cuban Missile Crisis, the Cambodia invasion, the Iranian hostage crisis in 1979, the bombing of Libya in 86, entering the Gulf War 1 and 2, Afghanistan War, the Iraq War, even the recent bombing of the Iranian nuclear facilities. All of these events had immediate market jitters. But if you look 100 days after the fact, 200 days after the fact, by and large, again, market resilient, might be emotional in the short term, but long term, it tends to recover and continue to move on into positive territory, or at least recover from the initial jitters that happen after one of these international conflicts, which so often involve energy, right? It seems to be the leading driver in things. So not only are we seeing stock market jitters, but Erin, I think that the prices at the pump come as a shock to kind of the day-to-day budget for the Main Street American, which you know is as much of a sticker shock and cause for worry, I think.
For investors in watching these headlines and rising oil prices, what's the most important perspective we should keep in mind before making portfolio decisions?
I think that it is a long-term perspective. Keep that long-term perspective in the forefront of your mind whenever making investment decisions.
Right.
Do we think that the economy is going to be healthy 3, 5, 10 years from now? Do we think that the companies and the funds that we are invested in are going to continue to appreciate into the future? Not tomorrow, not today, but into the future, because investing is a long-term time horizon kind of activity. We do not base our investments on what's happening today. And I'm going to set aside day traders from this and swing traders, because I think that's more of a different type of strategy, not necessarily, I think, the one that works most effectively. So investing in the market has proven to work effectively over the long term, and we need to keep that in mind and keep a long-term time horizon. Now, the money that you might need today or tomorrow or this year or in the next 2 to 3 years, maybe you don't want to have all of the exposure of the market and these emotional swings that can happen in the interim. But that money that is 3 to 5 to 10 years or more away from being used, your long-term growth money, look, we are going to see ups and downs. In fact, I can guarantee 2 things about the market. It's going to go up and it's going to go down at some point into the future. But more often than not, and over time, it is up more often and to a much greater magnitude than it is down. And we just need to keep that in mind so that we can avoid those emotional mistakes that we might compound and make on the emotional reactions of the market.
I'm so glad you just said that, Peter, because that brings us to our last visual and our last question, which is the fact that we as humans tend to make emotional decisions. Why is that bad for our finances generally?
Yeah, and this chart that you're seeing on the screen, there's a couple running jokes about the market. It is basically buy when things are high, sell when things are low, and repeat until broke. Or how do you make $1 million in the market? Well, you start with 2. Right. But this chart is showing the emotional component of the ebb and flow of the direction of the market. And as things are hot, as the market is moving high, people kind of get that FOMO and euphoria, and they want to buy in, and they think it's going to last forever and that it's always going to be this good. And it's not. And then things happen and the market declines and falls and retreats. And then people start to worry and they get scared and they say, oh no, I don't want to be exposed to this risk. So they sell out when it's down, and then they lock in those losses and they miss out on the ensuing recovery. And Erin, we've had other charts and visuals in past videos that show if you just miss a few of the best days in the market, how big of an impact that has. And
there you go.
Again, yeah, great. Thanks. You have it right there for me. You're wonderful. If you look at when those best days have happened, though, over this time period, and this is looking 2006 through 2021, if you look at when those best days that this chart shows us missing actually occurred, oftentimes it is right after some of the worst days, the most nerve-wracking days, the days that cause people to make emotional mistakes. So again, if we are investing, that money should not be today money. And in fact, we need to keep in our frame of mind that this is money that ultimately we are not depending on today. Otherwise, it shouldn't be invested, and that these downturns not only don't affect today, but may even actually be an inherent opportunity or an advantage to do some effective investing if we have the plan in place that gives us the guidelines that we feel comfortable with the risks that we're taking in the market.
I'm glad you said that. It all comes back to having a plan, recognizing that, as you mentioned, long-term goals are the priority, not how we feel at the moment in response to these headlines.
Absolutely.
That being said, Peter, finding a financial plan that is in line with your risk tolerance is going to be different for everyone. If somebody would like to sit down with you, make sure that they have that long-term financial plan, what's the best way to reach you?
Yeah, you're not going to find it. You got to create it. Each plan is your plan. And that's why we construct the optimized retirement plan for our clients at Richon Planning. It is a long-term planning outlook, the vision of your goals into the future, diversified strategies for how to achieve them, personalized, customized to you and your situation, taking a look at income, investments, taxes, healthcare, legacy. Taxes, by the way, much more controllable than the market. Maybe one of our best opportunities. Being effective with taxes is as effective as shooting for higher returns, but generally with far less risk. So if you want to tone down the risk and still make some good progress, you need to put all of the pieces of the picture together. That's what the optimized retirement plan that we put together at Richon Planning for you, for our clients, is all about. If you'd like to get that, just give us a call. You can call or text, by the way, 919-300-5886, 919-300-5886. If you text, just text your name and we'll get it. And then we'll give you a return text or a call back, or give a call, talk with the team. We'll get in touch with you, get to know you and your situation, and then figure out how to coordinate a time that is convenient for you if we would like to agree to put together that plan. And I welcome that for anyone listening. Everyone should have a plan. And that's why we make this a complimentary courtesy service to put that optimized retirement plan together, Erin. 919-300-5886. Or you can go online, the website, richonplanning.com. It looks like richonplanning.com.
Great. Peter, thanks for your time today. I appreciate it.
Yeah, don't get too thrown off by day-to-day news headlines. They all seem to be doom and gloom, but the market is something that is resilient and over time can provide great opportunity. So don't just discount it altogether or make an emotional mistake and get out at the wrong time. Long-term planning vision.
Peter, thank you.
Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.